Hey guys, it's Alvin here, and on a typical day I will speak to at least 3 investors and a builder, and there's a lot of things that we discuss in those meetings that would be great for a general audience to understand to help them make better decisions whether they're looking to invest or build. And so what I'm starting to do is I'm going to do a daily video where I'll be sharing some of the conversation that we're having. Today's about Trump, so let's go ahead and jump right in. All right, so we have our title up. It's straight from our YouTube playbook, Blame Trump for Absolutely Everything. So I'm going to dive into this a little bit further, but there are a couple of things I just want to say up front. This is not designed to be a political conversation. I'm not trying to sway your opinion. I don't care who you vote for. That's not what this conversation is about. What this conversation is about is that there is a lot of daily news that comes out, and we got to figure out like how we use that information to make smart investments for our family, for our portfolio, for our wealth building opportunities. So that's what today's conversation is centered about. And the other thing is you can't blame Trump for everything. A lot of things that are occurring in our marketplace has been occurring before him, will continue to occur after him. So we're looking at specific items or specific events, but understand that the cost of construction will always go up. It's just a matter of fact. Part of that is that since 2022, the cost of construction has gone up 30 to 50%. You can't blame Trump for everything. And again, it's very likely that this would have been the same fact whether he won or not. So going hard into numbers, it is a matter of fact that cost of construction went up. And the implications are impacting everyone, whether you're looking to rent, whether you're looking to buy, whether you're an investor. And the cost of construction can be a good or a bad thing, depending on how you play it. Let's look at to what impacted the cost going up. So Trump led with a 25% tariff. It since has come down. But the point is we do have about an 18% tariff right now on Canada, specifically on the soft wood coming down. For some reason, the Canadian wood is better than the American. We also get some imports from Mexico as well, but there is overall an increased tariff environment, and that's going to make the cost of construction going up. And so one of the things that we saw from the last administration from Biden is a lot of the tariffs that Trump's put in didn't go away when Biden came in. A lot of them were in effect. So there was a set net raise after Biden, after Trump had raised them originally. So that's going to impact everything. Also, when you look at our appliances, washer and dryer, or steels, concrete blocks, or everything you can imagine, there's an additional cost tacked on. And so whenever you're in an environment where the cost of goods are going up, and again, inflation plays a role here as well, that's a permanent fixture of the economy. The cost to build something is going more expensive. There are very few things that are going to happen that are going to reduce the cost going up in the future. So skilled labor has been an issue in the US for several years now. It's a trend that's getting worse. Essentially, America over pushed and over promoted going to college. So now we have too many highly educated people, in quotations. What we were disincentive is people going to welding school, going to become an electrician. A lot of the people you need to build these types of houses. And so what you find now is that a lot of the people doing these types of jobs are either they're old and they've been in the trades for a long time, or a lot of them are illegal immigrants. Or so that's the bucket of labor pool that we're actually building these properties. And I don't care where you are, you see the same profile almost everywhere you go. So I visit Miami often, have family in Miami, have family down here in Cape Coral, right? We know a lot of people in both communities, both that are illegal immigrants and legal immigrants and whatever. And there is just a short supply of that. And so what it means is that it becomes harder to predict your timelines. So if you have a tiled guy and that's the guy that you have, and it's hard to replace that guy, you're going to be waiting on him to do each one of your properties, which means that there's going to be a delay. There's also going to be an increased cost for those that are skilled. And it's actually a great thing to do if you're in high school and you're looking to graduate and you don't think you're going to college. Going into the trade is going to be an excellent opportunity because, again, there's so few people entering that field that if you're a business owner, you're going to do very well to that capacity. And so those costs for those skilled wages are going up as well because they're in such demand. And so, again, this is a permanent fixture. There is no straight solution to solve for this. we're going to see a lot more labor costs going up in the future. So again, we have the cost of goods and the cost of labor. And then to add to that, you also have the cost of financing, right? The cost to actually get a construction loan on property. It's been elevated for a while. We're not going to attempt to blame Trump for that one, but it is a factor that's been very persistent. There might be changes to that, but again, right now, it's super expensive to get a construction loan. And this is kind of an important moment in history where the campaigns are over. All of the things that were promised were already said. It's already in the public sphere. And now we're getting to like the reality of what's occurring. So there is a split currently happening with Trump and Elon. And if I were to put my Elon hat on, I would say, hey, I thought we were trying to reduce government spending. I thought that was the whole point of Doge. And so when you look at the largest expenditures that America has, which is military, Medicaid, Social Security, Elon Musk didn't really make a dent in any of those things. In fact, he didn't even get a chance to investigate the military. And so much more that the one beautiful bill actually increases the military budget. So if you're Elon Musk, you're saying like, well, my whole job was to reduce the government spending, not to encourage the administration to inflate these numbers. That's obviously not an alignment, which to me is very clear as to why there's a split that occurred. And so I don't know the specifics of it. I tried to figure out the pros and cons of each. If we focus specifically on just for real estate investors, the clear main benefit is now we have 100% bonus depreciation. And so if you are an asset owner like I am, if you're actively buying real estate, I have to buy a property once a year just because of the tax benefits. I'm going to make a lot of great use out of this bonus depreciation. It is a major benefit for me and other investors like me. So this is a huge win for investors. The downside for investors is our country might collapse. So when you increase our spending, increase our debt, you don't really have a way to pay for it. Everyone's saying the debt's going to go up. It's been going up. I'm not saying that someone else would have made a difference, but just when you just look at the way government spends money, it's just clear that we're overspending and there isn't enough mechanisms to control that spending. We just keep going in the opposite direction. So I was talking to one of my agents. He was like, hey, keep in mind that if it didn't go through, all of our taxes would have gone up quite a bit. So that was another benefit to this, is we were able to lock in the Trump administration era. And another quick point is that this is going to roll back some of the funding going towards electric energy, and so that was another tension potentially to why there's a split between Elon and Trump. Either way, it's a mixed bag. We'll take the good. Hopefully, we'll keep praying for America, but we need to get our spending under control. So when we go deeper into the pros for investors and with the construction costs going up, we're going to see a lot less competition. And so typically in this environment, you should not be doing ground up construction unless your goal is to accumulate brain trauma and eventually build the skills and the callus in your hands to be wildly successful as a developer. The truth is the market is not great right now for ground up construction, and we're seeing a lot of mid-sized builders kind of slow back and roll back. Peak permitting was in 2021. Since then, we've seen a rollback. So some of the inventory that we're seeing now hit the market, what was already being built back then, and it's kind of working our way through the system. But now it's not a good time for ground up construction unless you're looking to become a developer. And there will be less competition for developers. So if you're someone who's building 10 properties a year for yourself to hold on to, there's going to be a lot less competition for land, a lot less competition for labor, and you could start building a competitive advantage. But again, you should do this if you're looking at the long run of becoming a developer. If you're looking to do one or two properties, it makes absolutely no sense to do ground up construction in today's market. When you look at the higher rents, at some point, right now, depending on where you are in the market, you might have a saturation of rental availability, might be too many. But that's not going to last long, especially if building continues to go down. So we could enter a time period where in 8 months, a year and a half from now, we start seeing we go back to having an undersupply of rental availability. And so that would be the advantage for the investors. Obviously, appreciation will go up as less gets built. There's huge tax benefits we mentioned, and these are locked in. This affects absolutely everyone, not just investors, but the bonus appreciation specifically for investors is absolutely massive, and that cannot be ignored. So when we look at interest rates are likely to start ticking down. With the costs going up, if you were to say, hey, I want to make properties more affordable, reducing interest rates will make it cheaper to own a home for a while. What it's also going to do is start increasing the prices. Right now, we're in a market where purchase prices haven't really gone down as much as you would have think, just given how affordable prices are due to interest rates. But we are entering a time period where if interest rates were to go down, now we would start seeing that demand come back in, because there is pent-up demand. Just people are looking at their pocketbook, people are looking at how much a home is per month, and they're saying, well, I'm just better off renting. So if that were to reverse, we should see a huge uptick at that time period. So when we look at the cons for investors, it's going to cost more, right? So even right now, construction loans cost more, interest rates are higher, labor, material costs are all up. So it's going to cost you more to play the game right now. And it'll likely cost you more in the future as well, which is why if you have deep pockets, you're going to keep deploying capital. If your approach is to sit on your hands and wait, I don't know when you're not going to be on your hands anymore, right? I don't know when that time period occurs, when you're going to have the bravery and now skill sets to start deploying capital, which is why I always stress the importance of actually building high income skills so you can build up that savings net and you can start deploying capital regardless of what's happening in the market. And that's the key to being a very good investor, is you're just dollar cost averaging. You're just continuously putting money in. And if you can do that, you'll be successful. The deals of 2020 are gone, right? That's not going to happen again. We're now in 2025. You have to make your decisions based on today's numbers, assuming that a couple years from now it's going to be even more expensive. So that's what you're taking advantage of. The other thing is we're going to take a reduced profit margins. So again, if you look at historically, you might be able to say, hey, I used to be able to ink out more. You will get that higher profit margin. You're going to have to buy now and hold until that time comes, right? But you're not going to be able to go back in time. And you can try to do things to get more profit margins, but that usually increases your activity level. So again, for investors, you might have smaller margins than historical, but you start now and you get those benefits down the road. The other part is you're going to have to do due diligence. So 3 years ago, you could buy anything, and then you fast forward a couple of years and you were a genius. Now we're at a time period where a lot less deals cash flow, and you have to be a lot more methodical. Additionally, we don't know the market of a year and a half from now. So you're going to have to get in a market that has high cash flow, that you feel well protected. That's not a speculation. That you have very high confidence in the data, and that's going to be the levers you can start playing to start deploying some of that capital. And there's going to be market volatility. We saw the whole thing with Elon and Trump, right? It's ridiculous. I don't know how to play that. That's just volatility. But if you know your numbers well, you're in a heavy cash flow position, and you're not trying to do these tricks or these games that you're on that gray area, just stay all the way in the positive. Don't cut it close, and then I think you'll be just fine. But these are, what you have to be very realistic about when you start exploring and analyzing today's market. So what are the key takeaways? Costs are going up, buyer demand is low, and builders need to sell. So that's the other part of it, is if you're a builder, especially if you're that move-up builder, you can't beat Lennard and D.R. Horton and KB Homes on their cheaper quality hamster homes. You're not going to be able to beat them at that price point. Most mid-sized builders care a little bit more about their product. So they've been going after the move-up market. So after someone bought their little hamster home, they would then move up to an actually nicer home that they feel proud of, right? And so that's a move-up market. That move-up market is shot right now. Very few people are buying that type of nicer home with a pool and everything. That demand just isn't there. So that's why the prices are a little bit lower, which is your opportunity to now buy properties below their replacement cost, right? So If a builder loses money, that could be great for you if you're the one who's taking advantage of it. If you're the builder, you got to change a couple of things. But so this is exactly the same playbook that I did on my end. I bought a nice single family home about a year ago. It's in a fast emerging market in Inglewood, just a little bit south of Venice, Florida. And you can ride your bike to the beach and not be in a flood zone. The homes just nearby, just like 7-minute drives away, are $1 million, the same exact model that we have. And another just right next door would be about 50K higher. So it's in that always growth end. And so I know the builders personally. I know kind of where the finances are. And if we run the numbers, we'll see exactly what I did. So at the upper left-hand corner here, you'll see that the cost, if it's by the cost of building, the appraisal, you'll see that it's at 370. So the appraisal is saying, hey, to appraise the property from the cost perspective, the cost to build perspective would be about 370. All right, so the appraised value, we see it a little bit less. We see at 356. Again, the cost to build about 360. That should be 370. That's my mistake. 370, and then we see that the appraised value is 356. We're selling these for 332 to our investors, and these rent out well. Again, I'm an owner of one high appreciating market. And the rents are pretty high for this area as well. It's higher end, has double doors, has nice tray ceilings. This is not your typical low-end rental property. This is actually a higher end neighborhood. And the residents of this community, they demand a little bit of a higher end property here. A lot of the homes that are neighboring this one are even nicer than this one, which is a good thing. You want the houses, you want the market to carry the values, not your property, right? So we're not the nicest house in the street, which in this case is a good thing because other homes are selling for 420, 450. So the other thing we're getting closing cost concessions of 2%. When you use that towards your rate buy down, and contribute points, we can get investors down to 5.5% interest rate. So that's been a phenomenal deal. But this is how you would play it. You'd buy the property below its replacement cost. The builder is, not being profitable on this. They have to exit these properties. They can't hold on to them. And that's a net benefit for the investors. So I'm very confident this is a very high appreciating market. It's actively being built up and developed. It's near other cities that have properties that are a lot more expensive than this, and this is where the natural progression is going. To get more information on deals like this, you can go to buildtorent.com. You can also schedule an investor consultation, get more information, and then we'll see you there. Hey guys, thanks for watching the video all the way through the end. Now I want to hear from you. Leave your likes and your comments below, and I'll be answering each and every one of them.